Hey everybody, hope you're having an awesome day. Happy Monday, August 14th. Hope you had a good weekend and having a good start to your week. If you're watching this video, you probably are seeing it from our monthly newsletter. So this is our August newsletter. So thank you for reading these. We appreciate it. We hope we're providing some level of value to you guys, giving you some insight in what's going on in the marketplace, what new products exist, how we can help you guys in your goals, whether that's accessing money in existing real estate, purchasing new real estate, figuring out ways to finance that new real estate or finance existing real estate, get you in connection with a trust attorney, financial advisor, CPA, insurance broker. If you have any of these needs, we're going to try and keep helping you with all these things. But kind of a really hot topic, of course, this calendar year has been interest rates, right? We've kind of had this sticker shock because for 2020 and 2021 and a good portion of 2022, I should say the first 3 or 4 months of 2022, rates were the best they've ever been historically in the history of our country, right? And now we have this sticker shock because rates are about 3 times as high as they were, 2, 3 years ago. And so we're having we're having a hard time grappling with that, right? So I wanted to create a little slide here that kind of explains how we can combat consumer nerves, but your consumer nerve surrounding rates, right, is now a good time to buy. It's so expensive, right? The money I'm borrowing at a very expensive cost. But what if this is the perfect home for me? Or what if this ultimately will fulfill our needs? One adage I like to use a lot is we marry the home and we date the rate. And a lot of times we forget that. We forget that the rate is not permanent. It's very temporary. Right? In a year from now, 2 years, 3 years, 10 years, the rates may be lower. They likely will be lower at some point. We refinance and we get that lower rate, we get that lower payment, but we cannot get back the purchase price we bought the house at, right? That's set in stone. So I wanted to give you guys kind of 5 or 6 different ways that can help you with combating some of these nerves and combating interest rates today, right? So the first one here is our rate rebound program. You've probably seen me talk about it a lot, but it's really, really important that you guys know what it is, because the rate rebound program is a product that we provide because we service all of our loans. So when we do the loan, we actually service it as well. But it's basically 5 years that you can come back to us. It could be one time in that 5 years. It could be 10 times in that 5 years. I know I put 5 up, 10 times in that 5 years. And you can get a free refinance. So what does that mean? It means we will cover all of our lender fees. We will pay for the appraisal for you. We will give you $1,000 credit towards title fees, which on a refinance, title fees are probably right in the realm of $1,000, maybe $1,500. So you get a free refinance. This is significant because, going back to the old adage, you date the rate. If rates go down in a year, they go down a half or a full percent, sweet. Refinance it down, get a lower payment. If in another 2 years it goes down again, sweet. Do it again, get another lower payment again. So this really kind of helps when you're shopping today to know that you kind of have guaranteed free lower rates on the horizon that are going to be given to you because you're a client of ours. The other thing is a float down. Our float down, this is really neat. When you're under contract, if we lock your loan day one of the contract, let's say today that's 7.5%, but on day 14 or day 21, the rates move down from 7.5 down to say 7.25 or 7%. We can do a one-time float down and re-secure you at that lower number, that 7.25 or 7%. So it's going to guarantee that you get the lowest rate out there when you're under contract. So this protects you as well, which is really cool. The other one is our all-in-one loan. This is a specific loan. I don't want to get into the details because I do like a 30 to 40 minute presentation on this loan, but basically you can have a direct effect over the interest that you're paying on your mortgage based on cash flows or savings, based on money moving from one account to the next. This can directly offset your interest cost. We have borrowers today who will do this loan, and the real rate on this loan is maybe 7 or 8%, but the effective rate based on the money that they have and those things I just talked about might only be 2 or 3%. So it's a really cool product to help combat rates. If you want to get some more information on it, reach out to me. I'm happy to talk to you about it. Temporary buy downs. You may have heard this too. Basically what this is it's a temporary buy down of the interest rate. So let's say rates are at 7.5 per day or 7.5% today, but you can get closing costs from the seller and they are willing to contribute enough to give a temporary buy down. We call it a 2-1 buy down, or it could be a 3-2-1 buy down. What that means is the first calendar year you own the home, rates are 2% lower than the market. So if your rate today for the market is 7.5%, it means that first year it's going to be 5.5%. So 2 points lower. The second year it's going to be 1 point lower, 6.5%. And then on the third year, it will set to 7.5%, and it'll be that for the entirety of the loan. But the nice thing is for 2 years, you get a lower interest rate. And let's say after year 1 or year 2, rates have now permanently dropped, you can then do a refinance and now take advantage of that permanently. So it's a way to kind of avoid these higher rates for the first 2 years potentially. Now, assumptions are kind of a hot topic as well. An assumption is basically assuming an existing loan. Now, government loans are able to be assumed. Conventional loans are not. Now, what that means is, let's say you go to buy a house and that owner of that house has an existing FHA loan, and that existing FHA loan is a 2.5% rate. You can assume that loan. Now, you have to qualify for that loan, and you have to put enough money down to get to that loan amount, meaning if the purchase price is $300,000 and their existing loan amount is $250,000, you would have to put $50,000 down to get to that loan amount, that difference between the purchase price and the loan amount. But if you can do these things, then you can basically assume and take over. That loan is now yours, and it's yours at that 2.5%. So it is another way that you can kind of combat these higher rates. And lastly, this is more for those who are looking to do a cash out refinance. We kind of talk about HELOCs. A HELOC, or a home equity line of credit, is a nice option over a cash out refinance, because for those of us today that have a low rate, 2, 3, 4, 5%, we don't want to do a cash out refinance, which is a whole new loan based on today's rates of, say, 7.5%. We want to keep our good rate, right? But with a HELOC, you can do that. So if I have my regular 30-year fixed loan at 3%, and that's a $200,000 loan, but I need access to like $25,000 or $50,000 or $100,000, I can say, look, I'm going to do a HELOC. That HELOC might be a 9%, 10% interest rate. But remember, a $200,000 loan at 2% and a $50,000 loan at 9%, I can do the math for you guys to show you that that 250 together is the equivalent to a 250 loan at 3% or 4%. That is still much better than a whole new $250,000 loan at 7.5%, right? So HELOCs are a really great option as well in today's world. So if you have any questions on any of these, by all means, reach out to Rebecca and I. We're happy to go over it with you. This would be something we would go over in a mortgage consultation as well. So once again, hope you're having a great summer. For those of you that have kids, hope you're getting into school and doing all right. And as always, if you need anything, just holler at us. Hope you're having a great day.